I understand why Bitcoin went from 19,000 on March 13th, the week after the weekend of Signature and Silicon Valley Bank basically going into receivership. It was a flight to safety, 19,000 to nearly 28,000. That boy was that proof of concept right there. Decentralized, transparent, auditable, and so forth.
According to monthly reports from ARK Invest's Bitcoin, while the U.S. banking sector suffered with bank runs, Bitcoin, Ethereum, and other cryptocurrencies continued to function normally. In fact, during the March banking crisis, Bitcoin increased by 49% from $9,000 to $29,000, proving to be a haven for investors. As the centralized and opaque traditional financial system continues to reveal its flaws, demand for transparent, auditable, and decentralized financial services has skyrocketed. Despite regulators blaming cryptocurrencies for the financial crisis, attention should instead be directed toward the traditional banking system's centralized sources of failure. In a brand new interview on the ARK Invest YouTube channel, Cathie Wood discusses her analysis of the present markets and the brittleness of the banking system, which has strengthened the argument for Bitcoin.
Many people had their money in deposits at the bank, and this crisis actually has forced them to focus on what they're earning in the banks versus what they could get into money markets. So you see them in their minds, what they're saying is, I am going to lower my risk by leaving the banking system and increase my return. Now, isn't that upside down? That's not how the world works. And this I worry about from a bank deposit point of view. And the reason for this is lending. And ultimately, lending is going to shut down. But what people have talked about, available for sale, you mark to market right away for that, quarterly. So that hits earnings. Held to maturity, if you sell those, it hits equity. But what they're not talking about is the rest of the asset side of the balance sheet of these regional banks. And it's real estate, commercial real estate. 75% of real estate loans out there are, if they're from a bank, are done in the regional banking system. And I would submit that that residential will be hit in another way, because there has been so much overbuilding with the capital markets now facilitating this of multifamily homes that we have now coming online, the largest number of apartments in 40 years. In 40 years. So we were going back to the 70s, which was, so when I look at that, I said, okay, that was real estate speculation. That was inflationary. But I do think that rents will now come down dramatically. Velocity's coming down. And I, again, worry about GDP and economic activity.
Most banks have some amount of unrealized loss in security. How big a deal is that? Who the heck knows? The point is, though, that all like a flock of pigeons, the entire market has been spooked, right? Cash is now a risk asset. People are, moving to money market funds. People are, moving into big banks. All this money is now liquid. It's digital, and it's moving around like a cloud, and it's looking for the safest thing. And if some of that starts getting out of the system into Bitcoin, that is hyper-Bitcoinization, right? Or it is Bitcoinization and then eventually hyper-Bitcoinization, because it's looking for safety. And once it realizes, if it realizes that actually within the system there isn't safety and it starts seeking an exit, that's basically the thesis. All this money is being rendered super liquid and digital. And then what's going to happen is with something like FedNow, they're going to try to impose capital controls or blocks on it getting out of the system. So that's kind of my thesis, as opposed to micro things about what's going to happen over here. People don't think their money is safe in the bank. The assurances that people are getting are conflicting. They're like, oh, on the one hand, you're responsible for going through all of your bank's 10Qs. And on the other hand, Yellen is saying sometimes that they're going to back all deposits. You have basically not FDIC, but you have FedDIC, right, where all 18 trillion gets backed. The net effect of that is maximum uncertainty plus maximum liquidity.
Yes, I think, and so here we're back to the velocity question. Everything you have just said, tells me velocity will go down and that the risks to the economy are to the downside here, including inflation. So here we're coming to the same as we started at the beginning. I understand why Bitcoin went from 19,000 on March 13th, the week after the weekend of Signature and Silicon Valley Bank basically going into receivership. It was a flight to safety, 19,000 to nearly 28,000. That boy was that proof of concept right there, decentralized, transparent, auditable, and so forth. So we are on the same page here. I worry that that this economic downturn, this deflation, is a much bigger problem right now. And I do, if you're going to say, well, they're just going to throw money at it, we just saw that the Fed raised interest rates for the first time ever in the middle of a crisis. And today, this week, they've been talking once again about the need to increase interest rates at the next meeting. So I don't think they respect market signals. And this is a big problem. They are not looking at market signals. They're looking at massively lagging and unreliable indicators that are based on, in a world, the statistics came from the industrial age. So they're not even looking at the right numbers. Pricing signals are the most important signals right now. Credit default swaps, interest rates, yield curves, right? Bitcoin, yes, I agree with that. But I think you might have your hyper inflation of Bitcoin. And I think what we're coming to, if you seem to be nodding when I say what I'm saying about the banking system and the risks to the economy, it's not going to be inflation. It is not going to be inflation that we're worrying about this year. It will be something else. It may be counterparty risk, but I don't think it's going to be inflation in the prices of goods and services. And many people will say, "Oh, the dollar is going to collapse." Well, the dollar is measured. If you're measuring it in terms of prices and goods and services, right now, it's going up if you're looking at commodities, right? The dollar is appreciating. If you're looking at it in terms of other currencies, after a 25% run in a very short period of time, it's come down. But at the same time it's come down in the last few months, commodity prices have come down. So what does that tell you? During my discussion with Art Laffer last week, we were talking about Bitcoin, and he said, we really need to add, in terms of trying to figure out what's really going on out there in terms of the money multiplier, add Bitcoin to the monetary base and we'll get a better picture. So he's already thinking in this way. And I was so happy that he said it. Half of the solution is understanding a problem and understanding how we should try and frame things to understand what's really going on out there. So this idea of adding Bitcoin, which is a little over 500 billion, to the 8.5 trillion in the monetary base, it was a start. And, a start of a conversation, because we do have to deal with the world we're living in. The one you're talking about, I think will evolve over time, but it doesn't happen overnight. You might say the banking crisis is giving us that opportunity, and I think it may happen faster than otherwise might have been the case. But I am going to continue paying attention to market signals. I see credit default swaps settling down a bit. We haven't seen the regional bank index break down again, but it hasn't V-shaped either. So I think that's a risk there, that there's another episode. So we're watching all of this very carefully and watching the stock market. Now, the stock market is very sensitive to all of this. And it is very interesting for me to watch the stock market levitate through all of this. And I think one of the reasons it smells the end of rising rates. it sees over whatever the Fed's going to do right now to much, much lower interest rates because of this deflationary pull from monetary policy and gone wrong, velocity falling, and that's the bad deflation side of it. But then you've got the good deflation side of it, as you said, and I always want to end on a very hopeful note. And the very positive form of deflation we're going to see, if we're right, is going to cause enormous growth in everything blockchain related, in all that innovation, as well as, the other platforms, the multi-omic sequencing, robotics, energy storage, and artificial intelligence. And they're all going to start converging. And, it's messy. It's messy getting from here to there. But I think, again, just the recognition of what can go wrong with the banking system, I think is going to cause more people to seek more insurance policies.
The increase in the price of Bitcoin may indicate that investors are becoming more aware of the possibilities of cryptocurrencies as a more safe, decentralized, and stable investment option. How would you rate Cathie Wood's interview? Please share your feedback in the comments area. I really appreciate you dropping in.